pay attention to this. I am going to read this, and it might bore you, but it's very important. Came in the late 2008, early 2009, when risk premiums were extremely high, interest rates hit zero, and the central banks began aggressive quantitative easing, which is printing money and buying financial assets. Investors took the money that they got from selling their financial assets to the central banks and bought other financial assets, which pushed up the financial asset prices and pushed down risk premium and all asset classes expected returns. As in 1932 to 1937 period, that caused financial asset prices to rise a lot, which benefited those in financial assets relative to those without them, which widened the wealth gap. We have a big wealth gap, the rich and the poor, the haves and the have-nots. At the same time, technological automation and businesses, globalization, production to lower cost countries, China, we started shifting a lot of our production away from the US to other countries. And in doing so, it affected us, it affected our production. And those in the middle and the lower income groups, while more of their income gains over this decade went to companies and higher income earners. Okay, so you're just seeing the beginning of the wealth gap, the haves and the have-nots. It's been widening during this period of time. Growth has been slow, inflation remained low, equities rallied consistently, driven by continued falling discount rates, interest rates from the central bank stimulus. High profit margins, in part from automation keeping wage growth down. And so that just basically means that the wage growth has been kept down because there's been lots of automation. Until just recently with the pandemic, wage growth has started to go up. And more recently from tax cuts. So there was big tax cuts during this time. Meanwhile, the growing wealth and income gaps helped drive a global increase in populism. Now the asset prices are relatively high. Growth is priced and to remain modestly strong, and inflation is priced to remain low until now. So as we draw a conclusion and we start to just look at these different periods of time, we have to understand that there is a paradigm shift coming. The central banks have been lowering interest rates and doing quantitative easing for quite some time since this pandemic. And in doing so, asset prices have spiked. If you were looking at this chart, these prices have widened tremendously. Interest rates to the monetary. These are all just different charts. I'm just reading them, but here's the deal. The coming paradigm shift. There's a saying in the markets, he who lives by the crystal ball is destined to eat glass. Okay, what does that mean? You can't time the markets. Well, I'm not sure exactly when and how the paradigm shift will occur. I will share my thoughts. This is one of the leading hedge fund companies in the world. This is a white paper that you would probably never read, or even if you did, you may not understand it, but I do. So I'm trying to parallel that back to where we're at today. But listen, I think that it is highly likely that sometime in the next few years, and I want to be clear, this white paper was written over a year ago, sometime in the next few years, number one, the central banks will run out of stimulant to boost the markets and the economy when the economy is weak. The economy right now is weak. It really is. It's delicate. It's a fragile little thing. And what just happened? You just saw the government try to push through another stimulus called the infrastructure package, right? And it didn't go through. $3 to $5 trillion it was supposed to go through, never made it through. Check, sign. Okay, number two, there will be an enormous amount of debt and non-debt liabilities, pensions and healthcare that will increasingly become due and won't be able to be funded with assets. Said differently, I think that the paradigm that we are in will most likely end when A, real interest rate returns are pushed so low that investors holding the debt won't want to hold it and will start to move into something that they think is better. Okay, people that own bonds, people that have money in banks, people that have money in CDs or money markets, or people that own treasuries are moving all of that money into higher risk asset classes and have been since the start of the pandemic, because the low interest rate environment makes it hard and makes it difficult for people to want to hold those debts. So they seek higher returns in riskier assets. We've already talked about that in prior periods, in prior decades, and you understand where that went. And B, simultaneously, the large need for money to fund liabilities will contribute to the big squeeze. The big squeeze. you may not know this, but the pensions and the Medicare and all these things on the government relate to GDP. And there's charts in here that explain it. We are at about 1,100%. The government's liabilities are about 1,100% of the GDP. So what does that mean? Do the math. For every dollar the government brings in GDP, 1,100% more goes out in funded liabilities. They just can't sustain that. That's going to result in the big squeeze. And in doing the big squeeze, at that point, there won't be enough money to meet the needs for it. So there will have to be some combination of large deficits that are monetized. Currency depreciations. Are you not seeing your dollar go down in value? Yes, you are. It is by design, because you're hearing this right here. And large tax increases. Tax the rich. Your taxes are going up. Rich or poor, it doesn't matter, because inflation is a hidden tax. So your taxes are going up. Listen, this was written prior to what's happening today. So pay attention. And these circumstances will likely increase the conflicts between the capitalists, which are the haves, and the socialists, which are the have-nots, the people with money and the people without money. Most likely during this time, holders of debt will receive very low or negative nominal or real returns in currencies that are weakening, which will be the de facto and will be the wealth tax. You've already heard about this. So you can see that. You can see what's happening. And in here, it goes on to even talk about this even further. And there's charts that explain all those private debts and how the enormous amount of debts can't be met by the GDP. So that will pose problems. And I could keep going and going, but let's just bring this down to kind of where we're at. Folks, if you look at history and you study, and I only went back to 1920s, but I've studied back to the 1500s. I have a chart over here that brings me back to the 1500s. And if you really look at that, you can then start to see where we're going. And folks, I hate to say it, but we very well may be close to what I call the storm, but would be the next Great Depression, because you're seeing all the signs. Russia, Ukraine, incredibly low interest rates. The Fed now increasing interest rates, which will stall the economy, which will stall the markets, which will then put the brakes on and drive us into the next phase, disinflation. I don't think the problem in the future is so much going to be inflation, although it is a problem today. I think the problem in the future is more so going to be deflation. Look it up, folks. All I'm telling you with this podcast is now is the time to get ready. It is the time to plan for the storm. We just got 36 inches of snow here in Buffalo. And you know what? Before the storm came, everybody was rushing out, making sure that they had shovels, making sure that they had salt, making sure that their plow guy or their plow woman were called so that their driveways would get plowed. They stocked up on food. They stocked up on water. This is just a normal thing here in Buffalo when we know there's a storm or a blizzard coming. Well, the storm and the blizzard might not drop snow on you, but the storm that's coming is already here. The storm that's coming is in the financial markets. The storm that's coming is due to the long-term debt cycle and the long-term capital cycle coming to an end, as well as the short-term cycle coming and gone. You know, that cycle is already way past, and they've been printing money to kind of keep us from falling off the cliff. But here we are, folks. The Fed has already said it. They're going to raise interest rates. Not only that, they're going to unwind the balance sheet. They're going to slow down and taper the bond purchases. They purchase, I believe it's about 19 billion, or I might even have it wrong, 19 billion a month in bonds. They're going to taper that, which means they're going to slow that down to stop it eventually. And then when they do that, they're going to start selling bonds in the open market, which is going to be like sucking all the liquidity out of the market, similar to the Spaceballs movie where the maid put the vacuum cleaner on Earth and sucked the liquidity out of Earth. Here we are, folks. Are you ready? Because this is the time where greed isn't good. If you've watched Wall Street, he said, greed is good. This is not the time to be greedy. And my cat right here, who's our shop cat, his name is Cash. We call him Lazy Cash. This is the time to pull back on greed. This is the time to be fearful. This is the time to be patient. This is the time to plan. And this is the time to make sure that you protect your financial house. So folks, I hope this was beneficial. I know it was a bit over some people's heads, but I'm just trying to take you back into history to understand a little bit about what I know so that you then can make a conclusion as to what you should be doing. Look at your 401k. Look at your investments. How much risk are you taking? And does the risk justify the reward? No, it does not. We are seeing major volatility in the markets. Up, down one day, 1,000 points, finished by 90 plus points. Down one day by 800 points, finishes just about neutral. What's today going to be? Is it going to be up? Is it going to be down? It's crazy volatility. You don't want this. Asset bubbles are getting ready to pop. And when it happens, you want to be on the right side of that.